All right, here's a wild thought for you. What if the same exact thing, I mean identical, was selling for two totally different prices at the exact same time? It sounds impossible, right? Like it breaks a law of physics or something. But believe it or not, this happens all the time in the financial markets. And that's where we dive into the fascinating world of arbitrage.
You can kind of think of it like a temporary glitch in the matrix, a price gap illusion. For just a split second, the market isn't perfectly aligned. And that little imperfection, it creates this tiny window, a crack in the system that's just begging to be taken advantage of.
So let's make this super simple. Imagine you're sitting at your desk and you've got two screens up. On one screen, a stock is trading for $100. On the other, the very same stock is listed at $105. What's the first thing that pops into your head? It's buy low, sell high, right? Of course it is. Well, that simple gut reaction, that's the absolute core of what arbitrage is all about.
So that instinct you just had, that immediate urge to jump on that price difference, it actually has a name. And it's not just some weird quirk, it's a fundamental part of modern trading. So let's actually put a proper definition on this thing.
Okay, here's the textbook definition. Arbitrage is basically the simultaneous purchase and sale of the same asset in different markets to profit from those tiny price differences. So in our example, you'd hit buy on the $100 stock, and at the exact same time, you'd hit sell on the $105 one, and boom. If we just forget about fees for a second, that's $5 in your pocket, just for spotting the difference and acting fast.
But wait a minute, you're probably thinking, aren't markets supposed to be super efficient? So why do these gaps even happen? Well, the short answer is the system just isn't perfect. You've got different exchanges, right? And they don't move in perfect lockstep. Then there are different locations. Prices can get weird because of local taxes or rules. And the big one, time and information lags. News can hit one place fractions of a second before another. It's these little cracks, these tiny imperfections that create the whole opportunity.
All right, so this whole idea isn't just one simple trick. It actually comes in a few different flavors, if you will. Let's break down the three main types of arbitrage you'll hear about.
First up, you've got spatial arbitrage. That's the classic one we've been talking about. Buying a stock on one exchange and selling it on another. Simple. Then it gets a little more complex with triangular arbitrage. This is a pretty slick move in the currency world where you can cycle through three different currencies, say dollars to euros to yen and back to dollars, and end up with more money than you started with. And finally, there's what's called risk or merger arbitrage. This is where traders are basically betting that a big company takeover is going to go through successfully.
Now, you often hear arbitrage being called risk-free profit. And on paper, that makes sense, right? You're just taking advantage of a price difference that already exists. But is it really risk-free? Let's dig into that a little, because it's not quite that simple. Yeah, this quote really hits the nail on the head. Everyone calls it risk-free profit. But that little warning at the end, hold that thought, that's the key. That's where things get interesting, because the reality is a whole lot messier.
And this is really the core of it all. The myth is that this is just 100% free money, totally risk-free. But the reality, it's more like low risk but extremely high stakes. The chance of something going wrong might be small, but if it does go wrong, it goes wrong in a big, big way, and incredibly fast.
So what are these risks we're talking about? Well, a bunch of things, actually. The biggest one is called execution risk. That just means that in the fraction of a second it takes to complete your trade, that price gap you saw, poof, it's gone. Then there are transaction fees, which can literally eat up your entire profit. You might run into liquidity risk, where you just can't buy or sell enough of the asset to make it worthwhile. And especially in crypto, transfer delays can be an absolute killer. By the time your funds move from one exchange to another, that golden opportunity is long gone.
Okay, so if it's this tricky and full of these hidden risks, who on earth is actually making money doing this? I can tell you one thing for sure. It's not the average person trading from their laptop. Nope. This is a game for the pros, for a very specific group of players who have a massive, massive advantage.
And when I say pros, I mean the real heavy hitters. We're talking about high-frequency trading firms, giant hedge funds, the proprietary trading desks at big banks, and these really well-funded crypto market makers. These are the guys with the money, the tech, and the raw speed to play a game that's just completely out of reach for the rest of us.
So what's their secret weapon? What's the one thing that puts them in a totally different league? It boils down to one single word: speed. Just pure, mind-bending speed.
And I don't mean being fast with your mouse clicks. That's not even in the same universe. We're talking about a speed advantage measured in microseconds. These firms are making decisions and executing trades in a time frame that is quite literally faster than you can blink.
So how do they possibly move that fast? Well, it's a whole professional toolkit. They have their servers physically located right next to the stock exchange's computers. They get direct data feeds, no lag. They've negotiated tiny little trading fees that you and I could never get. They have oceans of capital to throw at these opportunities. And it's all run by automated systems that are watching thousands of assets at once. Honestly, by the time a normal person like us even sees a potential price gap, for them, it's already ancient history.
Okay, so this sounds like a high-tech game just for the rich and powerful, right? But does it actually serve any bigger purpose? And the answer is yes, absolutely. It turns out that arbitrage is kind of like the market's built-in self-correction engine. It's actually a vital part of what keeps the whole financial system running smoothly.
And this is how that loop works. Step 1, a price gap appears. Step 2, the arbitragers, the pros with all the tech, they rush in. Now, by buying the cheaper one, they create demand, which pushes its price up. And by selling the more expensive one, they increase supply, which pushes its price down. And what happens? The two prices move towards each other until the gap is gone. They are like this invisible force that snaps prices back in line, closing the very opportunity they were trying to profit from.
And here is the beautiful irony in all of this. What seems like a totally selfish act, just chasing a quick profit, actually has this incredibly powerful, almost altruistic outcome. These traders effectively act like the market's immune system. They're constantly hunting for these little price glitches, and in the process, they fix them. They're the reason that when you or I go to buy a stock, we can be pretty confident that the price we're seeing is the right price, no matter where we look.
So, the next time you look up a stock price, just take a second to think about the invisible war being fought by algorithms in the background. That relentless, high-speed hunt for profit is actually what keeps the market stable and efficient for everybody else. Which leaves us with a pretty cool question to think about, doesn't it? Is this constant, greedy chase for tiny